Good afternoon, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with Tom Tzitzouris. He is the head of fixed income research over at Strategas, as well as my colleague and regular sort of co-host on these, Allison Schrager. She's with Bloomberg Opinion, also a senior fellow at the Manhattan Institute and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We are here to talk about the Fed decision that is coming out in about 15 minutes, but today is a special day. First time since 2020 that we get a CPI and a Fed decision on the same day. So it's a little bit of like a Woodstock of fixed income volatility, if you will. I want to get into what we're expecting for that Fed decision, but before we do, I did want to do a little wrap on the CPI numbers that we got earlier in the day. So the download here, the sort of TLDR is that core CPI came in 8:30 a.m. New York time at 0.16% month on month, seasonally adjusted on the core. The consensus had been expecting a 0.3, so that's a meaningful beat, right? And my opinion was that it happened sort of for a lot of the right reasons. So I've got a column out on this on Bloomberg, Bloomberg.com, and my take was, look, you got the deflation from new cars, but you also had that super core category that Fed Chair Jerome Powell has talked about a lot over the past couple of years, basically flat or slightly deflationary. The breadth of the thing was pretty encouraging. You didn't see inflation really slipping into any new categories, and rents, that so problematic category that includes owner's equivalent rent, rent of primary residence, basically stable at 0.4% month on month inflation. I'm hoping for a variety of reasons that that's going to step down heading into the back end of the year. But basically you got stability from there, and you got a lot of help in other categories. I have the graphic up here, and I'll just quickly take folks through what we're looking at here. Again, you see the usual breakdown where by core goods, sort of nothing doing on the inflation front, but slightly deflationary on a month-on-month basis. All of the inflation is in that core services category, and when you dig into that, that's this red bar. The long and the short of it is that shelter continues to account for really the lion's share of that. Transportation services had been a little bit problematic previously. That includes your auto insurance. It ends up being a drag this month. And, there are a lot of other small categories that don't particularly move the needle on the headline number, but I take some signal from them. I think they're potential canaries in the coal mine in terms of telling me what's going on with that demand pull. Recreation services cooling off meaningfully. Medical care services cooling off a little bit. That's my take. Tom, let me turn to you. You saw a big move in the U.S. Treasury market off of the back of this thing. I think last time I checked, 10-year Treasury yield was down 15 bips. Are you buying that market move, or are you fading it? Can you hear me, Tom?
Sorry, had myself muted there for a second. But yeah, we look at this move as largely expected, but we still believe that there's probably a floor on Treasury yields, particularly the 10-year portion of the curve. And so I wouldn't be a buyer at this level, but I wouldn't be fading it either. I think we can see 10s drift down, maybe as low as 4%.
Hmm.
before the end of the third quarter. Getting below 4% is really going to require a material shift, in my opinion, in the trajectory of Fed policy. And right now, if the market prices in, we'll say 2 to 4 rate cuts, that gets the Fed funds rate down to 450. It's going to be hard to get 10-year Treasury yields down below 4 if you only have, we'll say, 100 basis points of cuts. So I do think we need to see more weakness in the labor market to get tens down below 4. But as of right now, this move is consistent with what we would expect, and that is a gradual drift down to 4%.
All right. Allison, how do you think the Fed received this data? I mean, you got to think that they knew what they were thinking coming in before today. But here they are. We're going to get a Fed decision at 2 p.m. in 10 minutes. We're going to get a new summary of economic projections. And then we're going to get Fed Chair Jerome Powell in front of the microphone again. How is he thinking about this?
I imagine he's pretty excited. I mean, this is a very, I'm normally very hawkish and pessimistic that inflation is going to go down, but this is really the best we've seen in a long time. And what really struck me about it is the services, not, I guess, deceleration, I guess, is it seemed to me for a long time, and it made sense that, we had a lot of goods price deflation, that inflation was really holding on the service sector, which to me suggested it was really getting very persistent in the bones of the economy. So improvement in the service sector for me is very encouraging. And I imagine for the Fed too, that they really maybe aren't stalling at 3, but might make some real progress.
Okay. But how do you think about that together with the wage picture? Because on the one hand, you're right. Fed Chair Jerome Powell told us if we're going to have wage pressure turn up in consumer prices, we need to be looking at those core services, excluding shelter. And empirically, like, we're seeing good news, to your point. But those wages are not necessarily moderating. I think we saw a 0.4% on the average hourly earnings, if memory serves, last week. So we're still sort of seeing wage growth consistent with maybe like a 4%, something like that. Does that make you nervous at all that maybe we're getting a little bit of relief in these areas, but maybe it won't be relief for good?
Yeah, actually, I've been ruminating about that all morning. Because one of the reasons that this report was much better than I expected is, I said, the last wage report was quite high. And, when I was first strolling through the numbers, you see the one area that where inflation is up is, I think, food away from home, which obviously is very labor dependent. So,
Right.
I mean, I guess we'll just wait and see. I mean, 1 month of data, be it on employment, wages, or inflation, can be a little noisy. So it looks like, as I said, it suggests to me that there's some improvement, and maybe wage growth is slowing from this data, although the other data from jobs numbers suggests something otherwise. So it's hard to reconcile that. But hopefully, as I said, in the next couple months, we'll see which one's winning out.
Yeah, what do you think about that, Tom? Because I mean, you're a guy who's recently been telling me, and you sort of laid this out here too. We may see the numbers come down a little bit, but that doesn't mean that that's what's going to happen in the medium to long term, right? How are
Yeah,
you
and I
thinking
think
about this? Mhm.
the way I'm thinking about it is wages are telling us that there's an inertia to inflation. We haven't yet beaten back that inertia, that kind of muscle memory that comes with multiple quarters, if not years, of lag. With that said, I'm actually expecting that last month, or the May wage numbers, to actually be revised lower along with the payroll numbers, because I do think there's actually a little bit more slack in the labor market. The question isn't going to be, are we 4.1% or 3.8 or 3.9? The question is going to be, how quickly does that recede down to a more comfortable level, such as a 3%? Because I don't believe we can sustain 4% or even close to 4% wage growth without triggering eventually a second wave of inflation. So that's really going to be the question. The longer we stay here, the stickier, the stronger the inertia is to pull inflation back up to 4%.
Right. And of course, it is all sort of a function of where you think productivity is heading. I've said, several times on this broadcast that I'm sort of a productivity bull. But the jury's out. I would acknowledge we sort of had a period early in the pandemic where productivity kind of collapsed, and then we had a strong productivity period. If you sort of average them out, it kind of gets you back to like same old meh productivity. So how are you thinking about that, Tom?
Well, I tend to think about productivity in the long run and the short run. In the long run, let's say measured in decades to centuries,
Mm-hmm.
as we were having this conversation earlier in this week, there's really only two things that drive productivity in the long run, and that's respect for human rights and respect for property rights. And I do think that most of the globe is not doing a good job on either of those, and the US included. So I don't think the long-term prospects for productivity are all that great. In the short to intermediate term, measured in quarters to say a decade, I do think there's reason for optimism, and everybody talks about AI. But another thing I'd point to is you have to also, as a optimist, talking about the optimistic side of productivity, I think you also have to look at the lagged effects of work from home. Work from home is actually going to continue to be a productivity driver in the form of lifestyle and individual health and things like that. So I do think there are some reasons to be optimistic. But the thing about AI, which everybody likes to point to, is I think this is a 5 to 10 year productivity enhancer. I don't think it's a 5 to 10 month productivity enhancer. We have some near-term problems that are mismatching wages with where the Fed's target on inflation is, and I don't think AI really helps in the very near term. So I think it depends on what your time horizon is. In the intermediate term, let's say 3 to 10 years, I'm optimistic. In the very short term, I'm pessimistic, and in the very long term, I'm pessimistic.
All right. All right. So let me take us back to the sort of near and present real quick. Again, we're about 3 minutes out from a Fed decision. We're going to, of course, look very closely at what the language in the statement is, and we're gonna take a close look at that summary of economic projections, which is this anonymized sort of compendium of what policymakers think is going to happen, both with rates, but also with inflation, GDP, and unemployment. So I've got this up on our screen so we can watch it as it populates in real time. Where does the median member of the FOMC think rates are heading this year, next year, 2 years from now, and in the long run? Allison, with the 2 minutes we have left here, since the last time we've chatted, has your thinking changed at all on that long run estimation, which is ultimately a function of this funky thing R star that we keep talking about? Have we gotten any additional evidence, or are we still just sort of feeling our way around in the dark as to where the Fed is going to actually land this plane?
Well, where the Fed lands, I don't think we know much more. I mean, obviously it's only been a month, but I think long-term R star, I think of it as being driven more by sort of macro fundamentals of the economy. And I think a lot of macro fundamentals point to sort of structurally higher rates than we certainly had in the 2010s. And nothing about like this one inflation report certainly has changed my mind on that. I mean, as I said, we are just going to have higher debt levels. We might just sort of have a lot of geopolitical tensions that, pull back on trade and all those sorts of things. And that, to me, I mean, I've always been a believer that aging population could mean higher rates. So all of that to me points to the fact that we are just going to maybe have a higher R star. And that certainly hasn't changed and won't anytime soon, bar some major policy shift.
Yeah. It'll be interesting to see what happens here, and it'll also be interesting to see what happens between now and say 3:30 in the afternoon, because the trend has been that we get a move and then Jerome Powell starts talking and we swing back in the exact opposite direction. So you never want to completely trust that initial reaction. I tend to be a bit of a Jay Powell defender, and I think he's often misunderstood, but the market wants to read him all the time as sort of a hawk when a dove when he steps up to microphone. So here we go. Okay, so your decision is the Fed stays pat. No surprise there. We're still at a range of 5.25 to 5.5%. That's still a 2-decade high. No change there. You do see the median rate forecast moving up to 5.125% for this year. You don't see much move in expectations in sort of the back end. So that's moderately interesting here. Tom, what's your snap reaction in terms of the move in the dots? The median dot from Fed policymakers is now expecting the rate to end up at 5.125% at the end of this this 2024. So that's they've taken the 3 cuts off the table here.
Yeah, and from my eyeball, it looks like they've replaced 3 cuts with 1 cut, which seems actually a little bit aggressive to me in the sense that I think they could have gone from 3 to 2 and still been consistent with the evolution of the economic data. So, it's a little bit more hawkish than I'd expect. We're still sticking with our 2 cuts this year, September and December. So, it's a little bit more hawkish than I'd expect. And the immediate bond market reaction, I was just looking at 10s. 10s were up about maybe 2 to 3 basis points, it looked like. So a quick pop higher off of that projection from the Fed.
Okay, Allison, what do you make of it? I mean, you could say, well, it doesn't really. They're not really changing the trajectory. They're just sort of changing the timing, aren't they?
Yeah, which is what you'd expect. I mean, I think once the strong jobs report pretty much convinced a lot of the members of the Fed that that they were going to move more towards waiting for rate cuts. I don't know if you heard the interview with Neil Kashkari with Sumana Keynes a couple weeks ago, where I normally think of him as being quite dovish, and even he was just like, we're very wary of cutting too soon. And I think they're definitely veering on the side of being very conservative on this, because I think they are very acutely aware, as you just brought up, that if they do cut, that could actually be inflationary. And they don't want to be remembered as the Fed that, brought back inflation. So I think they pretty much decided from the jobs report, maybe 1 cut later this year, and 1 inflation report didn't move anyone.
Yeah. Let me give you all the key takeaways from our team here at Bloomberg News. These are their key bullet points that they've broken out for everybody, right? So, as we were saying, the dot plot of FOMC rate projections shows the median official now expects 1 quarter-point cut in 2024, 2 fewer than the previous round of quarterly forecasts in March. However, the median forecast for 2025 rises from 4.1 to 3.9. Is that inconsistent with the screen I had up earlier? You know what? The mistake is mine. I read it out incorrectly. So my apologies for that. So you do actually have a change in the path. The median forecast for 2025 rises from 4.1 to 3.9, implying 4 cuts compared with 3 projected in March. FOMC votes unanimously to leave the rate unchanged, of course. Officials tweaked the statement language to acknowledge modest further progress toward inflation goal in recent months. The median forecast for PCE inflation, which is, of course, the Fed's preferred gauge, they tend to use that PCE over the CPI. It rises to 2.6 for 2024, while core PCE projection rises to 2.8%. That's up from 2.6. The economic growth estimate for 2024 unchanged. Right. So it seems like, I mean, the changes that we see here in the outlook are basically a function of the revisions that they've gone ahead and done to the PCE inflation forecast. Right. I mean, you're seeing slightly higher PCE inflation and core PCE inflation that feeds through to the need to slightly higher rates there. Let's turn back to the job market, to the labor market here for a second, because an interesting thing about the price action today, we saw sort of 10-year yields shoot up off of the back of that unemployment, that non-farm payrolls report on Friday. And the CPI report basically served to completely undo that, right? We did a complete 180. My first question for you, Tom, is: do you trust the headline on that non-farm payroll number? I mean, non-farm payroll suggested we're creating a lot of jobs in this country, but unemployment actually moved up, and we saw broad disagreement between what the household survey was telling us and what the establishment survey was telling us. So what am I supposed to believe vis-a-vis the labor market here?
Yeah, well, I think what we're supposed to believe is that it was a very sloppy report and there's going to be substantial revisions to something or maybe multiple things. And if I had to kind of characterize what I think those revisions are going to be, it's that on average, it's going to be a weaker report in terms of both headline payroll numbers as well as wage growth. From there, how much weaker? I don't think it's going to be substantially weaker. I don't think we're going to be looking at, I think consensus was 180,000 jobs. I don't think we go that low, but I think we see a material revision lower. And I do think that we see wages revised lower, because I think the bottom line is the labor market is softening. You're seeing more slack building. You're seeing job openings reduced, and that should be translating into less jobs added. If you're seeing less job openings, it's not necessarily because you're adding more jobs. It could be, I mean, not because you're hiring more people and you're closing the positions. I think it's because the economy is gradually softening. So I think we're going to see a weaker number in revisions, consistent with the consumer price numbers as well, slightly weaker.
Okay, all right. And Allison, for your part, how do you think the Fed should be thinking about the balance of risks here in terms of their dual mandate, right? Because it is interesting that the market sort of gave the same weight in one direction to a labor market report, non-farm payrolls, as they gave to an inflation report. I sort of still think we're in a mode where inflation reports matter a lot to the Fed more than labor market reports, but the market doesn't seem to agree with me there. They seem to be seeing these two things weighted similarly. Where do you fall down? Where do you come down?
I think the Fed still does care more about the labor market. The thing is, we're squinting really hard to try to see a soft landing. And the fact is, the labor market's really still really strong. Maybe it's softening a little bit, but that was maybe only because it was crazy tight before. This is a really good labor market. I think it's telling that we just found out the Jackson Hole topic is going to be does monetary policy even really effective? And because they've increased rates and it really hasn't done much to the labor market. I think there's always been the dirty secret of monetary policy is no one really had a good story of the mechanism of how increasing rates really would bring down inflation, and always had some black box to do with the labor market. And you know what, even if we said we could say it's softening, it's not real. It's still a really strong labor market. I mean, in years past, we would have killed for this kind of unemployment rate. So I think they're focusing more on inflation just because the labor market really isn't doing that much. If we had a serious increase in unemployment, I think there would be serious rate cuts, and very strong ones. But the fact is, this is a really strong economy. I think the question is more, what's really going to bring down the labor market. It would probably be a big negative shock that we didn't anticipate. And I think the Fed is wondering, does coming into this with higher rates increase the risk? Does it undermine the resilience of the economy? And I think you can think about a couple different ways. You could argue yes, because a lot of companies are sort of hitting them at the maturity wall, might be getting a little bit weaker. On the other hand, if we do hit a shock with relatively higher rates, you also have a lot more scope to cut, and you might have more power that way.
Yeah, sure. Okay. Tom, I'm always curious, how we should be thinking about financial conditions here and what that's going to mean for the Fed discourse here, right? Because as Jerome Powell is thinking about this, he's got another 20 minutes to work out what he's going to say when he gets hit with those hard questions from our folks here at Bloomberg and Nick Timmeros of the Wall Street Journal, and he's gonna want to think about how he wants to come off, right? He's going into this and he's already seen a lot of effective easing in financial markets this morning. What has happened off of the back of this inflation report is going to feed into easier conditions in the housing market, and so on and so forth. It's going to make everybody feel a little bit richer, right? Does Jay Powell push back on that a little bit when he goes before the microphone, or is that just not his nature?
Does he push back on the fact that we've had financial condition easing as if it's not relevant? I'm sorry, was that the question, or are we looking at?
Yeah, exactly. I mean, do you think he tries to come off as slightly more hawkish to push back on this big move on yields?
Well, he hasn't yet, and he's had quite a bit of opportunity over the last, we'll say, 18 months to push back on what has been really no material tightening of financial conditions, despite multiple 25 basis point rate hikes. So, and to piggyback off of Allison's thoughts there about, we've seen tremendous amount of rate hikes, but we haven't seen an awful lot of softening in the labor market. And one of the things we always point to at Strategas is because the Fed has not used its balance sheet aggressively. So much of the economy today is levered to the 5 to 10-year portion of the curve. Literally, we're talking something on the order of 80 to 85% of the economy is actually levered to that portion of the curve. So your tightening has been so narrowly focused. So I believe the easing of financial conditions should be Jerome Powell's biggest concern about a second wave of inflation hitting sooner. Simply put, financial conditions easing should be a very worrisome sign. And for what it's worth, the Fed slowed its pace of balance sheet reduction starting in June. So they're already moving towards easing there. Even if they're not moving towards easing yet on the Fed funds rate, they're moving towards easing on the balance sheet. So that's got to be a very big concern. So if I were a reporter, I'd be asking Jerome Powell, why are you not worried about the easing of financial conditions? And I'm not sure we get a straight answer from the Fed chair.
You wouldn't have changed the balance sheet policy at this juncture?
Absolutely not. In fact, one of our phrases we've been saying at Strategas for a few years now is, when you use the Fed funds rate, you put more of the strain on Main Street. When you use the balance sheet, you put more of the strain on Wall Street. And we can extend Wall Street to mean large cap tech stocks, the US government, the largest states, basically your largest borrowers. The Fed has actually eased on the largest borrowers in the US economy over the last 18 months. They have eased. And you can see this in many measures. You can see it in tech stocks, companies that actually have positive net interest margins. They borrow in the 10-year part of the curve, and then they lend it to cash for positive net interest margin. Those are phenomenon that you just cannot ignore. And when you see financial conditions easing, it's really difficult to expect that we're going to see inflation eventually move towards Fed target of 2%, because easing conditions are not consistent with a further decline in inflation beyond, let's say, third or fourth quarter this year.
Allison, I think I'm in trouble because I'm the only one that's out there cheerleading the change in the balance sheet policy. I thought it was the right move, Tom, because I mean, the Fed's argument, which I basically buy, is that you're slowing the pace of runoff so that you can keep doing it for longer, right? The big concern is that you're going to have another accident, such as occurred in 2019, and none of us want to see that happen. And so, while there are always knock-on effects, you slow the thing a little bit, and you hope that means that you'll be able to run the program for months and years and into the future. Are you not buying my story there?
No, and for a couple reasons. And by the way, that argument is roughly what the Fed has publicly said, and they've phrased it in a more precise way to the effect of they want there to be ample reserves in the system. Now, reserves are roughly, we'll say, 15% of GDP. If that's not ample, I don't know what is. So we've already got ample reserves in the system. But let's go back to the event in 2019, the hiccup in the repo markets. My pushback on worrying about that is twofold. One, first, I'd say, that's what markets are supposed to do. When you pump too many treasury bills into the market, there should be a funding squeeze. That's exactly what should happen in a free market. To avoid that or to prevent that is to not let the market price supply correctly. But then my other pushback is, as a backstop, the Fed has added a standing repo facility, which allows them to add liquidity to that market when needed. Now, the purpose of adding that facility was, in my opinion, so that you could let reserves shrink faster and reduce the size of the balance sheet, and you could do more fine tuning. So why did they add a standing repo facility if they were going to continue to maintain reserves close to 15% of GDP? Something's not adding up in the Fed's decision to slow the pace of balance sheet reduction. And I continue to point to the thing that's staring us all in the face, that it was a political decision. It was not an economic one.
Oh my goodness. Allison, do you want to pile on here?
Yeah, I'm, as you know, I'm sort of constantly horrified by the size of the balance sheet. So, but I'm more inclined to agree after reading. I'm not sure if you read the op-ed by Daryl Duffy, who is, I think, the academic who understands the fixed income market better than anyone. And he also agreed that easing the runoff, was unnecessary and probably not a good idea. And I usually defer to him because he said he understands technical things about the fixed income market than I ever will.
Yeah.
But,
right.
I appreciate your point. It's tricky. And, I think the fact is maintaining a balance sheet this big, in the size of QE the last time, even the first time, we really are in uncharted territory. So I think, you can argue it either way because we don't really have good best practices for monetary policy on this yet. We're really sort of, this isn't, a new monetary policy tool that we're really just starting to understand. I mean, if you remember the first QE, everyone expected it to automatically be inflationary, and then it wasn't. So I think you can make a good argument either way. I'm just more sympathetic that they don't need to use.
Yeah, but I mean, won't the proof be in the pudding? I mean, if this was really the wrong policy for the wrong time, then we'll see that reacceleration of inflation in the back end of the year or something like that. But at the moment, coming off of this CPI report, it seems like empirically we have strong disinflationary momentum moving in the right direction, right?
Well, I would agree. That's where we stand right now. And I think, as we mentioned earlier in the program, I think we're going to continue to see that at least out until the end of the third quarter into early fall.
Yeah. So when you think about, the lagged effects of that balance sheet policy, Tom, do you have, a number of months in mind or something like that?
Well, my biggest concern is that they're going to stop balance sheet reduction completely, or at the very least stop treasury balance sheet reduction, and then begin to reinvest mortgages that are running off into the treasury market. So maybe the balance sheet is shrinking by 10 billion a month, which is negligible. but I'm concerned they're going to slow it more or stop it completely, and we're going to end up with a balance sheet that is forever 7 trillion. And when you have a balance sheet that large, you are grossly skewing valuations and wealth distribution across the entire economy. I would argue that the quantitative easing, particularly the last round, QE4, was the single largest contributor to wealth inequality in US history. And there are huge long-term political consequences for maintaining a balance sheet at 7 trillion. I would like to see that balance sheet down to 3 trillion.
So you reckon they're going to start buying mortgage-backed securities again soon?
No, I think what they're going to do is they're going to stop Treasury runoff completely, and then they're going to continue running off mortgages, but they're going to reinvest them into treasuries. That seems to be the trajectory they're on. And there's a big problem with that too. What they're doing, if they do that, is they're crowding out the housing sector to support the Treasury. So you'll see politicians rattling on about 30-year mortgage rates well above where they typically are. 30-year mortgage rate is already, we'll call it 300 something basis points or 275 basis points north of 10-year treasuries. That is an unusually wide level. And the biggest contributor to that is that the Treasury is crowding out the housing sector. And if you stop Treasury runoff and begin reinvesting mortgages into treasuries, you're going to further crowd out the housing sector. Now, people will say, well, housing's frothy anyway, but housing may not be frothy 2 years from now. You might see a housing market correction, and you still may not see 30-year mortgage rates come down to levels that would be supportive. So I've got grave concerns about how the balance sheet evolves going forward. And the Fed is not being very clear, although they've hinted that they want to slow it further, the balance sheet reduction. They want to slow the pace further.
You don't think that those mortgage spreads are just an expression of sort of inherent volatility in fixed income in recent years?
Well, much of the volatility is being driven by the Treasury supply. We've seen, as we've just talked about today, inflation itself has come down and inflation volatility has come down, both big drivers of mortgage spreads. So then the next biggest driver is Treasury supply. Treasury supply is driving yield volatility, and it's driving yield volatility more than it typically does. So that's one way it's crowding out the housing sector. But there are other forces that are keeping 30-year mortgage rates wide to where they should be. One of which is that, simply put, banks still are not allowed to come in and lend the way they might want to, like they did 15 years ago. So there's some disintermediation that is still played out over the last few years as well.
Yeah. Well, so let's stay right here in your core wheelhouse. So Treasury supply, right? So walk me through the timeline as you see it, right? Because we're going through a seasonal sort of lull in Treasury supply right now, right?
Yep.
But you see it coming back with a vengeance. Is that right, Tom?
That's correct. And so we just got through the big tax payment season in mid-March to mid-April. And as a consequence of that, the Treasury is flush with cash. And we're actually heading into another quarter-end tax payment season, which should be relatively strong, like strong versus last year. So you should see tax payments rising versus last year, which should also work to keep Treasury bill supply negative. So the Treasury is gradually paying down bills right now, and they're not increasing their coupon auctions anytime soon. Anytime soon, meaning presumably before the election. So we're in a period where supply is not really growing, and some corners of the Treasury market are actually shrinking temporarily. But then when we get to the third quarter, and particularly past September, you should start to see supply picking up. And in particular, next year, you're going to start to see coupon supply picking up, because we're still running $2 trillion a year deficits. That means we've got to borrow $2 trillion more this year, calendar year, than we did last year. And next year is shaping up to be another close to $2 trillion deficit. So where is that supply going to come in? It's going to have to come in the coupon stack. And once the Treasury raises those coupon auctions, you're going to get another bear market steepener where 5, 7, 10-year Treasuries ratchet higher, all else equal.
And so Tom, for those of us that aren't super in the weeds, Treasury's been doing a lot of bill issuance in recent years, right? And in a sense, it's kind of like being a home buyer and saying, well, rates are really really high right now. I'm going to take that 3 or 5 year arm, right? And I'm going to refinance later or something like that, rather than locking in the 30 year. Some right. so essentially, Treasury's forecast has been, I think, I think inflation's coming down. I think rates are coming down. I'm going to hold off on locking in those high rates. But it's your contention that at some point they're going to have to take their medicine. Is that do I have that more or less?
Oh, absolutely. And I'd also go so far as to say that the goal of issuing so many T-bills from last June till we'll say March of this year was really not to just kind of avoid locking in higher long-term rates. It was really to arbitrage and pull liquidity out of the reverse repo facility to offset the Fed's balance sheet reduction. So what we've termed this is it's actually Treasury-driven quantitative easing. Janet Yellen is a brilliant politician, and she was the former Fed chair herself. She understands how that reverse repo facility functions. And what she realized was if you can issue Treasury bills at pretty much the most expensive point on the curve to the US taxpayer, you can lure money out of the reverse repo facility and then pump it into the economy and actually flood the system with liquidity. So the Treasury has actually doubled the pace of Fed runoff. So for every dollar that the Fed has run off the balance sheet, the Treasury has pumped $2 roughly of liquidity into the economy. And that's by design. And that's been designed to smooth the run higher in the bear steepening in the Treasury curve. This is why they haven't been raising coupon auctions, because if you raise coupon auctions, you can't pull that money out of the reverse repo facility. So you've seen that reverse repo facility go from 2.6 trillion down to 400 billion. Most of that decline has been Treasury general account pulling money out of the reverse repo facility, going into the Treasury general account, and then the Treasury then flooding the economy and banks with reserves. It's all by design. When that reverse repo facility goes down to zero, let's say presumably now it's on a pace to do so around Labor Day or sometime in early Q4, then it's going to be pure liquidity drain. And this is why I'm so frustrated with the Federal Reserve's decision to slow the balance sheet reduction. Because if you look at the timing of this, the slowdown of the balance sheet reduction specifically means that the reverse repo facility was going to drop to zero sometime around July or August. Now it gets pushed out to the middle of October. It looks very political in nature.
Do you think that all of this business from the Treasury has ultimately been inflationary, undermined what the Fed is trying to do?
Absolutely, and through the predominantly through the wealth effect, through the mass affluent households and large companies, but also because the Treasury is financing, or that Treasury financing is being used to flood the economy with fiscal stimulus, substantial amounts of fiscal stimulus. So unfortunately, the Treasury and Washington, D.C. have been really working at odds with the Fed chair. And what it's forced the Fed chair to do is put more of that pain on Main Street USA, small businesses and households. And this is why you see, if you look at small business credit availability, we just got NFIB numbers earlier this week. It's telling us credit is still not particularly available for small businesses. If you look at small business optimism, it jumped a little bit, but it's still very concerning. Small businesses are being strangled by high interest rates, partially because the US government continues to overstimulate an economy that's already at full employment.
But Tom, you and I have talked about this a little offline, of course, and my take is sort of, there are a lot of moving parts in your argument, and I'm not going to even attempt to tackle all of them, but it seems like a plausible and innocuous explanation for what's really happening at Treasury is Treasury often, issues more bills when rates are particularly high, and their forecast is that rates are going to come down, right? The historical record suggests that this is sort of the way they do it. They're not particularly tactical. They're a slow-moving organization. And so, the innocuous, you're sort of saying that there's a political motive here, where that, they're trying to achieve something behind the Federal Reserve's back, in essence, or maybe in spite of the Federal Reserve in plain day, in the light of day. But the innocuous explanation is Janet Yellen just has a more optimistic inflation and rates forecast than you, right?
Well, she could have a more optimistic forecast, but I would argue that when the decision was made to increase those treasury bills, the bond market was pricing in her optimistic forecast with lower interest rates. So it made sense then to term out the debt at least out to the 5-year portion of the curve, if not 5s to 10s. So the market was in agreement with those optimistic views last year, and they still chose not to increase their coupon auctions enough to satisfy the large deficit. So they very clearly targeted the bills market for increased issuance beyond what that market would otherwise been able to tolerate had the reverse repo facility not been standing above 2 trillion at that point in time. And this goes back to 2019. The reason why we had a repo market hiccup was because there was no reverse repo facility to provide offsetting liquidity in the event of the Trump administration trying to blast $500 billion of T-bills into the market in a very short period. Today, we had that offset, and the Treasury took advantage of that.
All right, Tom, I'm going to have to leave you with the last word right now because I want to wind down. We've got Jerome Powell going live in moments. I want to say thank you to everybody for tuning in. I want to encourage you to check us out on social media. Allison has a great video that should be live right now. Please go ahead and catch up on my column on CPI this morning. Thank you very much to Tom Tzitzouris from Strategas for joining us this morning. Thank you too to my colleague Allison, and thanks to everybody for tuning in.
Thank you.